Euro clearing after Brexit is not exactly what you'd call front-page tabloid material. But buried beneath the jargon and policy acronyms lies one of the most strategic economic battlegrounds between the European Union and the United Kingdom since their messy divorce in 2020. For decades, London stood tall as the undisputed kingpin of financial services in Europe, not least because it handled the lion's share of euro-denominated interest rate swaps, derivatives, and other exotic financial beasts that most people outside Canary Wharf prefer to avoid thinking about. Even after Brexit, London's financial dominance barely flinched, particularly in the area of euro clearing, a crucial process where massive financial bets are safely settled through central counterparties, the so-called CCPs. Today, about 91% of euro interest rate swaps are still cleared through London, primarily via the London clearinghouse, the LCH, a number that has EU regulators twitching with both anxiety and determination. Because here's the issue. When you're an economic bloc that issues a currency used by hundreds of millions and represents around 15% of the global economy, outsourcing the plumbing of your monetary system to a foreign, now non-member jurisdiction is a bit like letting your ex manage your bank account. And the EU, now more than ever, wants control over its own economic levers, particularly in a world increasingly shaped by geopolitical fragmentation and post-pandemic strategic autonomy drives. In theory, the EU had long planned to claw back this clearing dominance, and back in the earlier phases post-Brexit, Brussels granted temporary equivalent status to UK-based clearinghouses, essentially giving them legal permission to continue doing business with EU firms. That deadline was meant to expire in 2025, and officials were adamant that there would be no further extensions. But in January 25, the European Commission, with a tone that was more sheepish than steely, announced another 3-year extension of equivalence, pushing the deadline to June 2028. But what changed? Reality, of course. EU-based clearinghouses simply don't yet have the scale, infrastructure, or liquidity to handle the colossal volumes that currently flow through London. A rush shift could have triggered serious market disruption, like financial whiplash for banks and investors alike. So instead of a crash landing, Brussels opted for a soft glide path. Enter EMIR 3.0, the European Market Infrastructure Regulation's latest iteration, which sounds like the sequel to a sci-fi thriller, but is in fact the EU's primary vehicle for wresting back control. One of its most talked about mechanisms is the so-called Active Account Requirement, or AAR, and this rule obliges EU financial firms to maintain a functioning account at an EU-based CCP and use it for a representative share of their trades. Now, this doesn't amount to a direct ban on using London's CCPs. It's more carrot and stick. On the one hand, firms get a regulatory nudge. Comply with AAR and you may avoid heavier bureaucracy. On the other, they face the risk of growing restrictions and scrutiny if they continue relying heavily on third country CCPs. But EMIR 3.0 isn't all bark. It also tries to make EU-based clearing more attractive. Brussels is looking to streamline product approvals, improve transparency or margin requirements, and build liquidity in continental CCPs. Because unless these venues become more competitive, EU firms simply won't move voluntarily. And that's the heart of the challenge. London's dominance isn't just regulatory, it's about ecosystem, expertise, and efficiency. Even firms that want to be good EU citizens find it economically irrational to abandon London's established clearing structures overnight. The active account requirement is due to kick in sometime this year. It's not the end of euro clearing in London, but the beginning of a carefully managed shift. The EU hopes that by 2028 enough volume will have migrated to the continent to justify letting the current equivalent status finally lapse. But market players aren't exactly lining up to cheer. Industry groups have voiced strong concerns about the lack of finalized technical rules, fearing legal uncertainty and operational chaos. They even requested a regulatory non-action letter, essentially asking authorities not to enforce anything until the details are ironed out. And behind the scenes, some regulators sympathize. The challenge of moving trillions of euros in financial risk is not trivial. And while EU officials publicly stress strategic autonomy and financial sovereignty, they are also wary of triggering unintended blowback on European banks. The ECB, for its part, is keen to see more oversight over euro-denominated derivatives. And from its perspective, too much reliance on UK-based CCPs hampers its ability to ensure monetary policy is transmitted smoothly across the Eurozone. In times of financial stress, that is a real risk. And let's not forget recent stress test moments like the COVID-19 pandemic or the energy crunch, which exposed how fragile global systems can be. In both instances, CCPs played crucial roles in absorbing market shocks. So having those key institutions outside the EU's direct regulatory grip is not exactly ideal. All of this means that euro clearing has become much more than a technocratic sideshow. It's a symbol of economic sovereignty, of Brexit consequences, and of EU's evolving stance in a world where financial infrastructure is becoming a geopolitical asset. For the UK, maintaining London's clearing supremacy is both an economic and strategic priority. Financial services remain one of Britain's few global edge industries post-Brexit, and euro clearing is a crown jewel. If Brussels succeeds in diverting a meaningful chunk of this business, it would be a serious blow to London's financial dominance. Yet for now, the status quo holds. Clearing continues in London, albeit under the ticking clock of yet another 3-year extension. And everyone involved, from traders to central bankers, is watching closely to see if Brussels can turn regulatory ambition into market reality. Because in the end, this isn't just about euro swaps. It's about who gets to sit at the control panel of Europe's financial system. And in the world of post-Brexit economics, control is everything. What makes this process even more complex is the political context in which it unfolds. While some see the gradual return of clearing to the EU as a technical matter, it is in essence an extension of Brussels' ambition to make its financial architecture less dependent on external actors. And this is part of the broader push for strategic autonomy, a term that now features prominently in every major EU policy communication. And euro clearing, with its enormous implications for financial stability, for monetary transmission and market integrity, fits perfectly into that narrative. The EU doesn't want to shoot itself in the foot by forcing an abrupt decoupling, but it does want to send a message, and that loud and clear, that control over critical market infrastructure must lie within the border of the bloc. From Paris to Frankfurt, policymakers know that real sovereignty means more than just legal competencies. It's about operational control in times of crisis. And when your biggest clearinghouse sits in a country whose regulatory alignment is increasingly up in the air, that's a vulnerability you cannot ignore. What remains to be seen is whether the combination of regulatory incentives, strategic rhetoric, and geopolitical pressure will be enough to shift the behavior of the market. Will banks really migrate meaningful volumes to EU CCPs? Will liquidity follow the rules or remain stubbornly attached to London's deep pools? The coming years will be the real test, because when the equivalence deadline hits in 2028, Brussels will have to make a call, extend again, fold, or finally pull the plug. And whichever path it chooses, the financial landscape of Europe will never be quite the same again.